Alrighty, I don't think any more are joining there, so we'll get going, folks, and then obviously people can join as they come along. Hi there, I'm Sam. Nice to see you from Simplicity, and my colleague Andrew here as well. Andrew is, gosh, he has so many fancy titles, it's not funny. CIO, COO, and he also empties the dishwasher around here as well. So he does everything. And so I'll do the bulk of the presentation, may cut across to Andrew every now and again for his comment, and then we'll go to Q&A, and where Andrew and I will answer questions for you as long as you want to ask questions for. So we just go on and on and on. So don't feel don't feel guilty at all about leaving early, or if you've got other things to do, but we'll just carry on answering every question as long as we can. So let me share the screen here, and so we can go to what we're going to talk about today. So basically, I thought there were sort of 6 topics here, talking about what's a very unpredictable world right now. Let's talk about that word inflation, which has resurged. Let's talk about whether the future actually looks pretty scary, as it can do, or actually quite cheery, which is my personal view, but we'll go through both of those options. Then obviously talking about what you can personally do with your investments, your savings, or if you're buying a first home. We'll go over quickly our performance and progress, which is very solid, and then go straight to questions. So I just want to remind you very quickly about why are we doing this? Why are we here? Why do we have these seminars? Why do we do everything we do? It's to give people dignity in retirement. And how do we do that? We give people choices, because a life with choices is a life with dignity. And what we do to do that is make our members more money. So while we're a charity, which owns a non-profit company, which is Simplicity, we are about making our members wealthier so they have more choices and dignity in life. And that's our structure. You may or may not have seen this before. We're a non-profit company owned by a charity. We give 15% of our fees to that charity. That's now running at over $150,000 a month, or something approaching, well over $5,000 a day now to charity. And that means it will be around forever, because we don't make any money, so we'll never be worth any money, so we'll never be bought or sold. And we do KiwiSaver investment funds and mortgages. And since we last spoke now, we're in the affordable homes business as well, which I'll talk about. So let's talk about our unpredictable world. And boy, is it unpredictable, because let's go back 3 years now to 2019. What were we all worrying about in 2019? Well, England had made the strange, unusual, and my personal opinion, crazy decision to leave the European Union. There was Brexit. The North Korean talks, which Donald Trump was making, remember Donald Trump was president back then, was making a whole lot of noise about, they had stalled. Trump had in fact been impeached, one of the very few presidents in history to have been impeached. And then there were these Hong Kong protests as well, massive people camping out on the streets and so on. And in spite of all that uncertainty, the S&P 500, which is basically the American stock market, was up 31% that year. So it was a very unpredictable world there, but this market still went up. Fast forward to now, and since then, well, what's happened? Well, we've had COVID, Russia has invaded the Ukraine, inflation has come roaring back, we've had supply chain chaos, people not being able to get the stuff that they've ordered, ships blocking up the Suez Canal, all sorts of stuff, which has made a very unpredictable and uncertain world. Very little of which anyone would have predicted in 2019. I think that's the most important lesson about all of this, is who would have predicted any of this. In spite of that, actually the US stock market, which is a reasonable proxy for the world, went up 16% in 2020, even though it went down 59% when COVID first broke, so hugely volatile, up 27% in 2021, and is now down 6% so far this year. A lot of that driven by interest rates, and we'll talk about that in a minute. But anyway, it's a completely unpredictable world. And, if you have a look at this in the context of history, this is an interesting chart which shows 100 years. I use this all the time because there's so many lessons in this chart. The gray lines are recessions, and this shows basically the US stock market. It's adjusted for inflation, which is important. It's also called a log scale, which means it doesn't overly dramatize any one event or another. And you can see there the big drops, the Great Depression back in the 1930s, what we call the Great Recession, which was in the 1970s, a period of very high inflation, the global financial crisis in 2008, and have a look at the context of coronavirus and the recent market movements. Actually, in history, not a very big deal. And there's a very important lesson in that, which is that it seems very noisy. We have, as human beings, we have this thing called a recency bias. We tend to over-exaggerate things that are happening right now, and we sort of take our emotions right now, we extrapolate them into the future, and we think the future might always be like this. Basically, what this means is we can get overly exuberant or overly scared depending on what's happening right now. And so if you have a look at coronavirus and the market downturns, been pretty scary, but actually in the context of history, not too scary. And overall, the markets have gone up. And the reason is because people set up businesses, they want to make a better living for themselves, they form companies which pay dividends. Basically, this is really a testament to capitalism. The worst form of economic organization except for all the others, as Churchill might say. So basically, it is unpredictable. It goes up and down, but over the long term, it goes up. Here's the other interesting thing, unpredictable. Interest rates are rising, and boy, have they risen. I think everyone's been surprised by this, or almost everybody. We certainly have been. And what you've seen is a sharp rise in interest rates. You see in the context of history there, them going from, call it 0.5% to over 3% in New Zealand is a pretty sharp upward turn. You'd have to go back, Andrew, it looks like you have to go back to sort of 1993, 1994 before you find something that shocking, yeah? Or that dramatic that quickly. So it's happened in a hurry. Why is that? Well, inflation. Things are getting more expensive. Look at the inflation curve here and you'll see it's jumped right up to levels that we last saw in 1991. And that's a pretty dramatic and pretty shocking upward turn, which very, very few people predicted. And why has inflation gone up? Well, the first of all is costs. This chart shows the cost of shipping a full-size container from China to America, which is the biggest container shipping route in the world. All of this stuff that the Americans buy and the Chinese manufacture. And you'll see that since about let's call it May 2020, when COVID hit, it steadily rose and it went crazy. It went from $2,000 a container to $18,000 a container, a 9 times increase. Then it went down again when COVID looked like it was receding. Then it came back up again with supply chain crises, and it's coming down again now. But we're still at a level which is over 5 times the cost of where it was pre-COVID. So that's very inflationary. That cost just gets built in to the price that we pay for everything. Now, it's interesting looking at that chart. Things may be moderating, they may be slowing down. The indications from other leading indices that you look at are that actually some of those supply chain problems may be easing up a bit. And then, of course, China shuts down for another wave of COVID, and then everyone gets worried again. So highly uncertain, but certainly inflation driven by costs. Here's the other thing. This is spending. This is the direct government spending on COVID relief as a percentage of their gross domestic product. You'll see in some cases it's absolutely enormous. Like Japan, 54% of their economic turnover in a year spent by the government, or the equivalent of spent by the government for COVID relief. And you see the number there on the right-hand side. If you add it up, it's about $9 trillion. Now, if you imagined, if you had a huge helicopter over the globe and you chucked $9 trillion into the global economy, you can imagine that that's people, a lot of people, it has to find its way somewhere. So a lot of people have a lot more money to spend on things. If you have got constrained supply at the same time, so just as people want to spend more, things are in scarce supply, the prices go up. Let's have a look at an example of that on one side. Let's have a look at things that are in very scarce supply and what happens when people have more money. This is from an very interesting website called The Visual Capitalist, probably after simplicity.kiwi, my favorite website in the world, tends to put things into pictures. Here are objects of desire, which are in very scarce supply, right? But all of this extra money, this is what people have spent on these things because they've had the money to spend, because the money has been printed and distributed as a part of COVID relief. Look at all the crazy amount of money spent on something. I never thought that someone would spend, look at number 9 there, someone would spend $1.5 million on a pair of Nike, what are they? I don't know what they're called, Andrew, I forget. But anyway, Nike sneakers is what I call them, or $6 million on a pistol, or, $43 million on a copy of the US Constitution. So that's an example of inflation happening when you have no increase in supply. When you have limited increase in supply, it may not be as dramatic as that, but it's still pretty dramatic. And here's the other reason for inflation: war. Inflation comes when wars start. We know from history that war causes inflation. If you have a look at all those wars on the left-hand side, all of them were inflationary. Why was that? Because the governments tended to print money and spend money to grow their war industries, and that meant the cost of everything went up. Cost of steel, cost of labor, cost of electricity, all of these things went up because you had to gear up for war. And on the right-hand side, you can see in this particular instance, have a look at all of these things that Russia and Ukraine export a lot of. So for example, wheat, they export 26% of the world's wheat. If you look at sunflowers, you put sunflowers, that sounds crazy, but look at it, imagine all that sunflower oil that we're cooking in. Russia and Ukraine export 50% of the world's sunflowers as well. Huge amounts of fertilizer, nickel, aluminium, platinum, palladium, all of these things are really important in the car manufacturing industry and in the battery manufacturing industry as well. So it puts pressure on car makers, particularly those that are building electric cars right now. So all of these issues, and we've already heard about, Russia, second biggest oil exporter in the world, massive exporter of natural gas to Germany. When those things become constrained, the prices of them go up. But look at the bottom left-hand corner. That's the cloud. The silver lining is that inflation very typically goes down when these wars end, because the same processes come into reverse again, more supply. And so now, who knows what will happen with the war with the Ukraine and Russia? My personal view, I'm no expert on it, but I'll give you one personal view, is I think Russia needs to be allowed to exit with mana, whatever that means for them. But there has to be an end game here where it's not completely embarrassing for them, as horrible as they have acted in this war. But on the assumption that it does end, and who knows when and where and how, inflation will typically drop. But what does inflation mean for investments? And we put this slide up in our last presentation. If inflation is up, it tends to actually be, in the short term, house prices can go down, because typically when inflation goes up, interest rates have gone up. And when interest rates go up, house prices go down, shares go down. But eventually those higher interest rates get reflected in the prices of those assets. So history tells us that inflation stays up in the long term, the price of shares and the price of your house goes up in line with inflation. It's bad for fixed interest, and you can see that in the short-term performance of our funds has been hit by the fact that when you own particularly long government bonds, they get hurt, or long-dated government bonds, 5-7 year bonds, they can tend to go down in value, because someone who wants to buy, say you bought a bond which is paying you 2%, if suddenly you could buy a bond which is now paying a 3% interest rate, well, you're going to buy that one, aren't you? So the value of the one that you own, which only pays a 2% interest, goes down, it loses value. And we also know that if inflation goes down, it tends to be, that's because interest rates go down, that also tends to be good for the price of shares and homes. They tend to be flat, or they can go up over time, and the bond markets go up. So if you look at the right-hand side there, financial markets, we've seen inflation we've seen interest rates going down for a long time, and inflation going down for a long time. That is why share markets have been strong, house prices have been strong, and actually returns on KiwiSaver funds have been very strong too. When inflation's going down, it's what we call a very benign environment for investments. When inflation goes up, it becomes a lot more problematic. You can get short-term swings, as we're seeing. Long-term, it'll be okay if you're in the share markets in your house. It can be okay if you're in fixed interest, but if you own long-term fixed interest, it actually be quite negative for some time, although that does correct eventually. So the other thing I'd say about inflation is, and you see, this is a chart I used last time. You haven't seen, this has popped out of this blue box, but this blue box here was, to the left of that blue box is what happened with inflation in New Zealand when the Reserve Bank wasn't charged with keeping it under control. It went haywire. Okay, it's all over the place, highly volatile. When the Reserve Bank Act came in, and the Reserve Bank was told that your primary job is to control inflation, that's what happened. It became much more benign and controllable. It broke out every now and again, but then it came back down again. Do not underestimate the tools that the reserve banks of the world have to get inflation under control when they get serious about doing it. When it gets out of control, as it is right now, they do have formidable tools. It does tend to cause recessions and economic slowdowns until it gets under control, but they can get it under control. Andrew, do you have anything sort of to add on that in terms of the power of the reserve banks to actually make life, to bring inflation under control?
No, not really. I mean, the thing that I think we've got to remember too is that in general, people are reasonably highly leveraged at the moment. And so if interest rates, and they are going up, that will impact people's incomes or spending, and therefore that will slow them down. So exactly as you say, the Reserve Bank's got some very powerful tools.
Yeah, thank you. All righty, and here's the other thing too. This is in the United States too, so it's not just New Zealand. In the United States, you'll see inflation has burst out of its band there, and you're seeing a lot of noise by the Federal Reserve there about how you get it under control. They have the tools to do it. It involves a little bit of economic pain in the short and medium term, but they can get it under control. So where is the market direction from here? We have no idea. Who knows where it will go? As you can see from what we've seen the last few years, it's a highly unpredictable world, and markets can be highly predictable too. But there are some really simple tools from your own personal perspective in terms of how you invest and how you save that allows you to weather this unpredictability, so that it doesn't matter that you can't predict where financial markets are going to from here. I love this quote by Mark Twain, because a lot of people saying inflation's away, it's going to go crazy, it's absolutely take it for granted, prices are going up now. I love this phrase, it ain't what you don't know that gets you into trouble, it's what you know for sure that just ain't so. So who knows whether inflation is around here for a long time or not, but anyone who tells you that they know that that is the case and is absolutely going to happen is basically saying that they know something for sure, and that's what gets you into trouble. When you bet on the fact that you know what's going to happen and you make a big bet on that, you can be very, very wrong. So what can you do personally? It's pretty simple. First of all is stay diversified in your investments. This is a chart that shows investment performance, different asset classes. So the pink boxes, for example, are emerging market shares. The light green box are investing directly in New Zealand property. And as you can see, it's a mess. Every year, the highest performing one, which is at the top, and the lowest performing one at the bottom, they change. And they can be quite random. So pick any color like dark blue. See how random it is over the years. So every single year, almost every single year, different investments go up and down that ladder in terms of how well they do. So how as a personal investor, can you possibly guess what that will look like next year? Even as a professional investor, I'd be a professional investor a lot of money that they couldn't guess what the top and bottom performing asset classes of the next year would be. So the best thing to do is have a little bit of everything, stay diversified. It means that it doesn't matter what the news is in the morning, you're not worried about it because you know that you've got, and in our case, we've got 3,000 investments in 23 different countries. You know that that's not going to be a problem. So once again, here's the perspective, the chart I always come back to, because you don't know what's going to happen in the world. No one predicted the GFC, no one that I read anyway. I don't think anyone I read predicted coronavirus. Maybe Bill Gates got it sort of right when he said we should be worried about this. And these things, and of course with the Great Depression, no one did either. So you have to be very, very diversified if you want to sleep well at night. Look, for managing the dollars, had a sleepless night with markets. Andrew, I don't know whether you have, maybe you have, but I certainly don't. So here's the other thing. So stay diversified, focus on fees. Here's the latest sorted website. And this shows our growth fund, our balanced fund and conservative fund. These are our KiwiSaver funds. It's very similar for our investment funds, showing you that the fees that we pay. So have a look at the growth fund there. This is for someone, a 20-year-old who's starting saving, retires at 65. So they invest for 45 years. They earn an average of $50,000 a year. And 3% the employer contributes percent contribution to current settings, right? So what this shows you, if you look at the growth fund, you'll see that our lifetime fees would be almost $14,000 in that fund. The average for all of the growth funds in the sorted website, which I think is pretty much everyone, average fee is $55,000. So focusing on low fees alone, so we are a non-profit owned by a charity. That's why we're so focused on keeping fees low. And by the way, what this other chart shows you is look at the services on the right-hand side. A lot of our competitors would say, you have to pay for service. You've got to pay this huge fee. What a load of rubbish. Here we are. We have services almost at the very top of what you can have. I haven't seen a provider who's got 5 out of 5 for services. So this is way up there. You can provide great service. We win all these awards all the time. And you can charge a low fee. You just have to want to do so. And as you can see with our returns, the returns are above average in all of our funds as well. And you'll see our fees are way, way, way below the market, because fees really matter. Don't believe it when anyone else uses these phrases like value for money or providing, an appropriate level of service for the fee. That's all wishy-washy words. Basically what they're saying is they're charging you probably too much for what they're giving you. And this is how little you can get away with. By the way, our growth fund and our conservative fund are the lowest fee funds on the sorted website, so no one charges less. In the balanced fund, we're third lowest. 2 of our competitors have done a couple of strange things with a couple of their funds, well, in our opinion anyway, which means they're lower than us, but we're still driving down fees, and that as we get scale, we'll pass that on. I think we've already given about 5 fee cuts in 5 years to our members as we've got economies of scale. So stay focused on fees. The other thing is about house prices. New Zealanders are obsessed with house prices, and for very good reason. 78% of New Zealanders' net wealth is invested in housing. It's our biggest asset class, residential housing. It is our biggest asset class by far. Now, as KiwiSaver grows, that number will hopefully go down and more money will be in KiwiSaver, but it's still huge. So we have seen massive house price rises. I haven't put in the house price falls since then because I just wanted you to see the massive scale of growth in house price rises. You will see we had to go back to 2003, 2004 to see house prices rise this much. I'd have a look also, look at that chart around about 2008, 2009. Do house prices fall? Yes, they do. We mentioned this last time. House prices can go down. Now, what that showed you is back then they didn't go down by very much, and it was because ultimately the rational market returned, as it were. Buyers returned because people needed to live in homes. And here's, I guess, the really important thing is, forget the short-term noise. The house price market is just like any other financial market, just like any other asset market. Short term, it's a voting machine. It trades on emotions and headlines and dramatic statements in the press. But long term, it's a weighing machine. Long term, the fundamentals come out, which is how many houses do people need to live in, how many houses are bought, and how attractive is housing as an asset class relative to other forms of investing like term deposits in banks or shares or so on. Now, here's a really fundamental issue here, which is about housing demand and supply. Because in 2021 in New Zealand, we saw a crash in supply. See how in 2020 and 2019, you had between 30 and 42,000 houses each year, new houses required to satisfy demand. It fell by 30,000 in 2021. Why was that? The borders were closed, no immigration. And of course, people in nervous times tend not to do things like trade up in houses or move around. They tend to sit where they are. And yet at the same time in 2021, you saw a massive spike. Because of that shortfall, you saw a massive spike in housing permits. So as the number of dwellings consented. Now, not all of those will be built, particularly in a higher interest rate environment when developers get squeezed. A lot of those house development may actually fall over. But one of the reasons you've seen house prices fall, one of them is because interest rates have gone up. They've become, mortgages have become more expensive. So people can't afford to pay so much. That's in the short-term phenomenon. But the really long-term one is that we had more houses consented than demanded. Now, that is unlikely to remain long-term. It doesn't mean that I think house prices will go up in the short term. I have no idea what prices will do in the short term. But long term, remember, long term, the market is a weighing machine. It's a rational machine. It looks at supply and demand, and then it looks at how affordable things are because of mortgages. So long term, you are more likely to see house prices rise than fall. And, if someone came to me and said, should I be buying a house right now? My answer would be, try not to second guess the market. Just go and buy the house that you can afford to buy right now, if that's what you want to do. So what is the house price direction from there? Same old question mark. Absolutely no idea. But if you look at the fundamentals of supply and demand, you would say that actually house prices are more likely to rise over the long term, So is the future scary or cheery? Because right now there's a lot of storm clouds, right? For all the reasons that we talked about beforehand. Well, here I think is the really interesting one, because this is both a scary and a cheery graph. This is what the world uses by way of energy. And you will see it goes right back to 1800. And we used to use, the chart at the bottom there used to say traditional, which was wood. And then there's coal, and then there's oil, gas, nuclear energy, and now renewables. And you will see the really scary picture here is that it doesn't matter what the world's been saying for the last 10 or 20 years. This is only a little coal using almost as much oil as we ever did, certainly more gas. I hate that too, because I don't like nuclear energy generally. And there's those renewables, we've been hearing about solar and wind and so on. It's still not a big slice of the global energy market. But therein is the opportunity. Because if you look at that chart, every single time you've moved up that chart and started using a different form of energy, there tends to have been very strong economic growth and a whole realignment of the economy. Imagine in the 1800s, when the world stopped burning, 1900s, that's when you had the revolution of the automobile, for example. And then when you had gas, you had a whole nother economic revolution as well, because power was a whole lot more cheaper than it was beforehand. Nuclear, you can argue about whether that was a revolution or not, but it was certainly a scientific revolution as well. People got very keen on that. And now with renewables, you have a huge amount of investment going into solar, wind, electric cars, basically electric everything. And we think that's going to be not only great for the environment long term, but it's also going to be fantastic for economic growth. Whole new industries will get massive momentum. Strangely enough, folks, the future is actually nuclear. And what I mean by that is, regardless of whether you think we should get into a new generation of nuclear energy with arguably safer reactors because they're carbon zero, the biggest nuclear reactor is the sun, this massive controlled fusion bomb, which is up there for hundreds of millions of years. That sends us all the sunlight to power solar. That sunlight creates all the wind dynamics to power wind. The future is nuclear in one form or another, hopefully with solar and wind, maybe with smaller scale, safer nuclear as well. And it's a very bright future. It's a very energy rich future that relies a lot less on fossil fuels and a lot more on solar, wind, and other forms of renewable energy, and that will spur economic growth. The other thing too is looking at it in a New Zealand context, and I keep on mentioning this, but it's happening. You can see it happening. KiwiSaver's changing New Zealand. Every single day, Simplicity receives net new money coming. It's very, very rare that we have to ever sell any investments in the market, because people keep on making their contribution, their KiwiSaver contributions, and they just keep on adding up. And it's millions of dollars a day for us, which means it must be tens of millions of dollars for the industry overall. And that just means that New Zealand goes from being capital poor to capital rich. And that is what builds our companies, what funds a whole lot of new technology. You know, we're already a significant investor in new technology, and we just got a tiny percent of our investments in that, in fast growth New Zealand companies, and it will help build a whole new generation of infrastructure once, we hope, the government starts realizing that KiwiSaver investors in New Zealand infrastructure might be a really good idea. So New Zealand goes from being capital poor to capital rich on a rising tide of capital, not a tidal wave, just tick, 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 and every day. It's a really good story. In fact, we know it's a great story because if you look at Australia, they haven't had a recession for 26 years. And once again, they've had a very strong economic bounce back post-COVID, because there's so much money being saved and invested in Australia by their own pension savings. So what is Simplicity doing? Just very quickly, just want to let you know, we kind of let the numbers do the talking around here. Since we became a default member, we've had a very large pickup in our members now. So they've gone from about 85,000 to 121,000. That just means we've got more scale. We're about $4.5 billion, as close as a little bit under that now. And once again, net money coming in, every day. The markets will go up and down, and so the value will come in, but net we're investing every day, saving a lot of money for members, $39 million a year versus the average fees that we, I showed you those fee comparisons beforehand. Gosh, that must be pretty close to $60,000 a day in fee savings or something like that. We're now giving away over $150,000 a month to charity, or about well over $5,000 a day there as well. And most importantly, two new numbers for you. We've almost hit $100 million in first home loans, which is fantastic, because those first home borrowers who are Simplicity members, they are paying the lowest floating rate mortgage in the market. Or if it's not the lowest, it's certainly one of. And also our investors are getting better returns, because that's money we would otherwise put in the bank. But we're now getting that mortgage rate back for our members. So that's starting to get some real momentum. Fantastic business. And we've also planted a whole lot of native trees now. One of the things our charity, the Simplicity Foundation, who are our ultimate owners, are doing is taking that 15% of fees, and a chunk of that is going into planting native trees, and we want to plant one for every member. We've just about got it right now. We've just announced a whole lot of new funding, and that will obviously makes a big contribution to the carbon footprint as well. It's just a really sensible thing to do, and it's great for the birds and animals and all that sort of stuff. The other thing that we're doing is we will invest a little bit of your money where we can have an enduring competitive advantage and make you more money over time. You've seen that with our mortgage business. We're making more money than we put it in the bank. We're doing that with affordable homes, and I'll talk about that in a minute. And then we're starting to make our first investments in private equity and venture capital. We've actually been funding New Zealand startup businesses via Icehouse Ventures now for, gosh, probably 2 years, Andrew. It'll be almost 2 years in Icehouse now. And that's it's a relatively small amount of money, but it will grow as we grow as well. The target maximum amount we have for all of these three things is no more than 7.5% in any fund, and it's lower for the balance. That would be the growth fund. It's lower for the balanced, conservative, and default funds. But we aren't anywhere near that limit yet, because we're just going to take our time and invest slowly and deliberately to make our members the most amount of money. So the vast majority of money will be invested passively, 3,000 investments in 23 countries in the world. We're just starting to make these investments now. Let's talk about building the affordable homes, because we announced Simplicity Living a few months ago, and boy, are we going gangbusters. Just to remind you, we think that there is a really, really good investment for our members in building really high quality homes to rent long term. We think that will get better returns than sticking it in the bank or government stock or local authority bonds or whatever. We think also it will be great for people who rent them, because it will give them housing security, and they will be Simplicity members, will be eligible to rent them. And this is very typically what pension funds do overseas. Just no one has done it here in New Zealand. No one in the KiwiSaver space has done it. So we're the first in New Zealand, but certainly this is a very well proven model overseas. We don't do anything for the first time. We just take what works overseas and bring it into New Zealand. So we're building them for 100 plus years. We've started building them. You'll see on the top left-hand side there, that's what they'll look like when they're finished, because NZ Living, who will become Simplicity Living, that's what they build right now. You see that we've actually started building. So we announced this a few months ago. This is the first site in Point, England, which has got 59 homes. And we have bought enough land now for the first well over 500 homes now. And so we're actually doing it now. It's actually happening. We're aiming for them to be carbon positive. That means that we plant so many trees and we minimize waste so much that they actually make a positive contribution to the environment. Already, this building that we're doing has about 1/7 the waste of an average building site, very focused on waste minimization. And then we plant many trees there, and then also we want to plant as many trees as required to take them into a carbon neutral or carbon positive offset. So that would be fantastic. We think they'll give very reliable long-term returns, because that's what happens overseas. And if you have a look at the rental market in New Zealand now, what we'd like to be able to offer people is secure long-term rents at affordable prices, which also give really solid returns for our members. There's a classic win-win here. And if we can end up providing thousands of warm, dry, secure homes for New Zealanders and make it a great investment for our members too, wouldn't that be wonderful? So we've actually begun doing it now. It's for real. In terms of what to expect in terms of our funds in the short term, as I said, if you look at these forces with inflation going up, shares and house prices can go down in the short term. Long term, they may go up. If you look at bonds, they could be flat and go down. And when inflation comes down again, it will eventually, don't know when, but that will be pretty good for the price of shares and homes too, and bonds as well. We'll get into what you call a benign investment environment. But right now, it's pretty choppy. Our performance has reflected that. So normally, you would expect us to see in the short term, well, gosh, Andrew's done and his team does such a fantastic job. Very often we've been in the top 3 performers. Over the long term now, performance has dropped off a bit because we tend to have a lot of that long-term government and local authority bonds. They have lost value in the short term. We know that over the long term, the investment thesis or the investment logic is that the longer term investments you have, the better off, the more money you'll make in the long term. So we're going to stick to that. That's led to some short-term lower performance, but as you can see on the 3 and 5 year rankings there, we're still consistently top 10 in every category. And you'll see that the value of those bonds dropping, that has hurt the conservative fund, which has a lot of them in it. That's why it's had over 1 year a slightly negative return. You see that with our investment funds as well. You'll see the conservative investment fund has gone down in value there as well. But once again, if you look at these things over the 3 year, we don't have 5 year performance data for these yet, but over the 3 year rankings, once again, always in the top half and then pretty consistently in the top 20%. So fundamentally though, very comfortable with how we're investing, focusing on very diversified, low fees, and then putting some money into areas where we think, well, in fact, we're very confident members will get better long-term returns. And we're also, quite frankly, it's great for New Zealand too. It's great that people can borrow money at a lower mortgage rate for their first home. It's great that people could move into long-term affordable rental homes. And it's great that we're funding new and high growth businesses in New Zealand. And just to bring you back to that same old chart again, as you can see, in the investment markets are choppy. They go up and down and up and down. But over the long term, they go up because people want a better world and people strive to make a better world. And so, and as you can see, in the context of history, what we've just been through with coronavirus and the markets going down right now are actually pretty small change. It shows you how you can get quite emotional about these things in the short term, but in the long, broad sweep of history, they're really not that big a deal. And as long as you're investing for the long term, you'll be okay. So that's what we talked about today, our unpredictable world, and it is inflation and its impact. Highly unpredictable in the short term. Long term, Reserve Bank's likely to get it under control. A pretty scary future when you think about the consequence for our environment if we do nothing, but quite a cheery one if you think about the fact that we have investment now in renewables. That's going to become a massive industry. Everyone's going to be thinking about it. What you can do is stay diversified in your investments, pay the lowest fees, and take a long-term view. And our performance is going great guns. Simplicity just goes from strength to strength as a business, all because of you, our members. So thank you very much. So it's marvelous. So Andrew, I think we'll go on to questions now, eh? Have we got some?
We do.
Let me just stop sharing here now so we can, there we go.
Great, thank you. And I'll just remind everybody that we're very keen to answer whatever questions you might have. If you just go into the Q&A tab, then send those through. And I believe somebody's monitoring Facebook. If you put any questions on there, they'll get sent through to us. A few of these are informational, really, Sam. So I mean, you'll be able to knock these off fairly quickly.
Yep.
Your depression recession comparison graph is on a log scale. Do you want to just explain that? Because this person has said that it makes the recent dips look smaller than the older depressions.
Yeah, no, it does, because if you think about a log scale, what a log scale means, it actually rebalances everything relative to the big number. So I'll give you an example. If you had the Standard & Poor's at say 3,000, which it was down in the in the pre-depression eras, and then it goes down to say 1,000. That's a 66% drop. So a 2,000 point drop is actually 66%. But if the market now, so the market was 30,000 and it drops 2,000, that 30 to 28 is a much, much smaller drop. So you have to take these point drops as a percentage of how high the market is in order to be able to compare the severity of these drops. Yeah. So it's like comparing things in terms of a percentage drop, not in terms of a headline number. That's why when you see in the press, a lot of people say, this is, the worst drop in the Dow Jones since the Great Depression. That's because the number, say 2000, might be bigger than it was, a number down in 1928, 1930. But actually, as a percentage drop in the market, it can be a lot lower. So you have to be very careful about the headlines. They tend to want to dramatize it. So I just wanted to show you that in the context of history, this has not been that big a deal in terms of a percentage drop.
Great, thanks, Sam. A question I think we've answered, but I will just cover it off again from Tony and also somebody else, anonymous, in terms of recent performance. The problem for us has been, which is for everybody, is the performance of the bond market, which has been extremely negative in the recent past. We, as Sam says, we tend to hold very long bonds compared to some of our competitors because we're in this for the long term. And in the short term, that has been detrimental to returns. But we're confident it's only a short term phenomenon.
Yeah, and I'd say also this, Andrew, and to the investors out there, you get rewarded for taking risk, right? So and so if you have a long dated investment bonds, it's actually a little bit riskier because the interest rates can move up or down and their values can go up or down more in the short term. But long term, you're rewarded for investing longer term. So we're highly confident that this is going to be okay in the long term. And boy, the first 5 years of Simplicity, we had a fantastic run there, didn't we, Andrew? It was as the interest rates went down, and we will again when interest rates go down. But we've got a choppy period right now while interest rates are swinging around and going up. That's okay. Investment logic, and in fact, 100 years of experience tells you that you'll be rewarded for investing longer term, as we are. We have most of our investors are very long term, so that's how we invest their money.
Great. One quick one, Sam. Do you know what percentage GDP got spent in New Zealand on COVID?
I think it was about, so if we say our GDP is about, let's call it, well, let's be slightly conservative here and call it a $200 billion number. It's about 170, 180 billion, but let's call it $200 billion. The amount of announced stimulus was about 60 billion. So that was about 30% of GDP. Now, whether that's all going to be spent or not, we don't quite know yet. So it could be up to 30%, could be quite a big number. Bearing in mind also, though, that is also in relative to our ability to borrow and spend money. New Zealand was relatively under-leveraged as a nation beforehand. We didn't have much overseas. We had debt to GDP at or about 20% at the lowest, round about there, Andrew.
That's about right.
So that takes our debt to GDP. Let's say we spend every cent. Debt to GDP goes to 50%. This is the most conservative assumption. Well, to put that into contrast, that is still, I mean, America's debt to GDP is 130%. Japan's 200+%. So we're still relatively lowly indebted relative to the world, which is one of the reasons why I'm so, long-term confident about New Zealand. We haven't borrowed ourselves to oblivion. Yeah.
Okay, a comment here from somebody else, anonymous, is that our slide on KiwiSaver is understating it because he believes, or he or she believes, it's already almost 100 billion. Is that right?
It's pretty close to 100 billion now, and you're right. We do tend to use conservative numbers. They were ones that the Treasury printed a while ago. So you're right. And in fact, KiwiSaver has traditionally outperformed in terms of the amount of money that's being saved. But, we like to be relatively conservative in these assumptions. Doesn't really change the fundamental story. And I think, if anything, you've given us a reason to be even more optimistic there, that there's just a huge amount of money being saved by New Zealanders for New Zealanders, and hopefully a good chunk of that will be invested in New Zealand. It's one of the problems with KiwiSaver now as a manager, when you're managing billions of dollars, is, Andrew, how much money would we have invested overseas now of all the money we have
It's about 65% of everything we've got.
Right. So 65% of our money is invested overseas because we can only find investments for 35% of the money in New Zealand, right? Now, we tend to benchmark ourselves versus the industry on this. So that's basically what the KiwiSaver industry is doing. It's got about 65% of its money overseas. One of the sad things would be is if we don't have enough to invest in our own country. So, you know, I think one of the responsibilities of the government is to help try and find a way to productively employ that money for the good of all New Zealanders, including investors and savers here.
Great. Here's a question from Tony, which, to be honest, I don't think we have answered anywhere, which is what is our estimated return going to be from Simplicity Living over time?
Okay, well, it's an interesting one. So it depends on a bunch of different things, but basically what we're targeting, Tony, is to capture what we would call a development margin. And so we can build at a much lower cost than most people in the market by virtue of economies of scale and the building systems we're using and so on. So we would expect to get a development margin of, let's call it between, just very conservatively, between 15 and 30%. That will be a one-off increase in value once the apartments and townhouses we build are finished. And then after that, we're targeting a real return of 3%. That means 3% on top of inflation in terms of over the long term for investors, which would be the equivalent of getting, you know, a higher fixed interest return. If we build a lot of these homes and have them rented out, it will start to feel very much like a fixed interest investment, not a property development investment. And in fact, that's how pension funds around the world invest in this asset class. They invest it as a substitute for fixed interest because it pays higher returns and, you know, doesn't get swung around by all these interest rate valuations. It's a much more reliable, smooth earner of money. So that's sort of what we're targeting. So if you said 3% real plus a development margin, that's what we will do. We're very confident from what we've seen in terms of the developments that NZ Living, who are becoming Simplicity Living, have done. They've already built 750 homes in Auckland and, you know, and sold them. We're very confident in that, both the development margin and the return we could get, but the proof will be in the pudding and we'll see. But what we have is a very vertically integrated development. So we take a lot of margin out all over the place. So it should be very attractive for members over time.
Great, thanks, Sam. Question from Seaton, which I can answer, I'm pleased to say, which is, do our fees, Simplicity fees, include the Vanguard fees? Yes, they do. The fees we quote are all up. There's no additional underlying fees. The usual question this time from Colin, thank you. Does Simplicity have any interest in investing in cryptos? And if not, why?
Sure. So crypto's been a fantastic, I'll use the word investment because I'm sure some people think of it as an investment. Some people would think of it as a little bit more speculative. But crypto has done incredibly well or incredibly badly, depending on when you've got in or out, but overall well. Why don't we invest in it? It's because it's an unregulated, untaxed asset class. And the problem with that then is we have little or no control over what will happen, or we have no one we can turn to if anything goes wrong. So for example, if we had your crypto stored in a vault and the vault was hacked and it was gone, can't go to the police, can't go to, and it's because it's untaxed, it can become, you know, we could be co-investing along with a whole lot of people who are doing some very unsavory things. And so we will look at crypto as a legitimate investment asset class when it is taxed and regulated like all other investment classes. Until then, pardon me, crypto is a little bit more like gambling than it is investing. Now, I know some people will take huge offense to that and say, here's all the reasons why it's a store of value. Here are the miracles of blockchain. And I've done, you know, a lot of reading on this. We understand that. But we have a fiduciary responsibility to make sure that every one of your dollars is invested in an asset class which has laws applied to it, which has regulators overseeing it, which has tax authorities taxing the profits on it, if and when appropriate, and so on and so forth. None of that applies to crypto at this stage. Things could well change there. And so could we be investing in crypto in the future? Sure, we could. It's possible. Could we also not be? That's also possible too. But it depends not on whether crypto goes up or down or how good or bad it is from a, investment or speculation point of view. It's whether or not it's a legitimate, legal, taxed investment. So that's why we don't get involved.
Great, thank you. Question here from Chris. If you're at retirement age and use the interest return on funds for income, you don't have the benefit of time, which means you start using equity. Any thoughts on that?
Yeah, and that's an issue for every investor who wants to start drawing down. But look, I would say this: for most people will live longer than they think, and so most people actually drawing down those funds over a relatively long period of time, which means that even when markets go down and you're taking money out, it tends not to be as significant. Now, to a certain extent, the law of compounding returns can work in reverse. So if markets carry on going down and you're carrying on drawing things down, you can actually eat into your capital quite significantly. And that's why a lot of people tend to be in more conservative funds, so that they're not, taking that risk. And so they have some a higher degree of surety about their capital. The problem with that is that in being in conservative funds, and certainly being in term deposits, is that when you're in an inflationary era, inflation really eats into the spending power of your money, right? And so you want to have some more, and this is not personalized advice because I can't give that, but as a general rule for a lot of retirees, they should have or think about having some of their money in other asset classes which benefit from inflation, and they tend to be property and shares over time, so that you can mitigate the effects of the decreased spending power. Because if you're only receiving the same amount of money every week and the cost of living is going up each week, you're basically losing spending power. You can buy less for your money. You want to try and get your investments to go up over time by being in those inflation sensitive asset classes, so that you can make money and have more to spend on a higher cost of living. So, it depends very much on your personal circumstances, but retreating into fixed interest exclusively or conservative funds may feel good at the time because you feel like you're protecting your capital, but it may not necessarily be the right thing for you to do long term. And in which case you can get over the emotionality of that just by being very diversified. Diversification, lets a lot of people sleep at night.
Great, thank you. Question from Nick is, how diversified are your funds? He believes that a lot of asset classes are correlated, and I often wonder which asset classes are uncorrelated.
Yeah, it's interesting. Well, I don't have time to go into the correlation coefficients of asset classes here. It's quite a technical thing, and if Andrew knows more about that than I do, but suffice it to say, yeah, very diversified. If you have a look at the asset classes we're in, you can see on our website, it will show you the asset classes we're in. It's basically 3,000 investments in 27 different countries. What's interesting also is that with these other investments we're making in affordable housing, mortgages, and private and venture capital, that makes it even more diversified, and the asset class correlation actually widens even further. So long term, we think we will get more diversified over time with less correlation. But look, you're absolutely right. In the short term, when interest rates go up, bonds lose value. Interest rates go up, the bonds lose value. The share markets get scared because you can now put money in fixed interest, and that might be better. So share markets tend to go down. Mortgage rates go up because interest rates go up when inflation comes along. That means housing prices goes down. For a long time, well, not for a long time, for a short period of time, all of these asset classes can seem like they're all moving down at the same time. But once again, as I say, short term, the markets are a voting machine. They vote on the emotion and they try and predict the future. Long term, they're a weighing machine. Ultimately, the fundamental laws come back into balance there, and you start to see, just use an example of inflation. When you get inflation coming, you can think, oh, inflation's horrible, demand comes down, everyone's scary, no one will spend money, so company share prices go down. Then when inflation comes in, some companies think, oh, we can put our prices up. So they put their prices up and their profits start going up. And so actually shares can do quite well in an inflation period over the long time, but over the short time, it can seem quite scary. We're still in that short-term scary phase. The world is getting used to inflation again, because it hasn't had to think about it very seriously for a very long period of time. But things do adjust. I'm not saying that high inflation is good. It's not. We want to have low, consistent inflation. But it is never always that everyone loses over the long time. There's always a silver lining to the cloud. And when you have a very diversified portfolio, some of those investments will do well. Look at COVID. COVID was terrible for share markets, but you know what? If you own drug companies, they went up. If you own medical supply companies, which we did, they went up. So, staying diversified is probably rule number one of managing your investments.
Great, thank you. Another question from Seaton. Is investing in nuclear fission power on the cards in the future then? Following on from your comments.
No, it's not. No, we don't have any sort of, in fact, we exclude all things nuclear because of the history of nuclear. I'd say this, though, I think that debate is going to start changing. It's interesting to see Greenpeace endorsing new generation nuclear electricity generation, because the new generation of reactors are, in theory, a lot safer and a lot more modern. It's interesting to see people like Bill Gates now working on a type of nuclear reactor which is theoretically impossible to melt down. Who knows whether that's in practice, but theoretically impossible. So and if you think about nuclear energy, it is, from a carbon perspective, it's, apart from hydro and wind and solar, it's one of the very few carbon neutral forms of generating electricity. So, and it's interesting to see that the United Kingdom now announcing that they're considering building 7 new nuclear reactors so that they reduce their reliance on Russian gas, which is, they don't want gas because it's producing carbon, but also it comes from Russia. So there's a political risk there as well. So it's interesting to see this debate is resurfacing about nuclear energy, but from our investment perspective, we don't have to worry about that. Your money won't be invested in that. And certainly in the context of New Zealand, of course, we won't have to think about that thing, hopefully, ever.
Great. Another question we do get asked quite often is, are we planning an aggressive KiwiSaver option?
What do you think, Andrew?
I think we've had this discussion, as you said, and yeah, I mean, it is something we've been seriously thinking about. We get asked often. We haven't come to a conclusion. Sam, you got anything you want to?
Yeah, look, I think there are clearly, particularly a younger generation of people, or people who'd like to have it as part of their portfolio, to have aggressive funds in there. And we're certainly getting now to the point where we can have a serious think about it, because we certainly have the investments that it could go into. We're obviously getting more involved in private equity and venture capital, which would be a natural home for some of the money in aggressive funds. When we're developing properties, there's a development margin there as well, which might be useful. There's obviously all these shares and equities to put things in, and a whole lot of new technologies. So, the longer and longer we get, and the bigger and bigger we get, the closer we get to making that decision. We're not quite there yet. We've got a few other things beforehand, but yeah, no, we're taking it seriously.
Cool. Question from an anonymous attendee. Do the homes we're building have passive heating features?
Yes, they do. So we don't need to put in heat pumps into them. They're basically built of environmentally friendly concrete. Now, there's no truly environmentally friendly concrete. We do a lot of that carbon offsetting with trees that we plant, but as environmentally friendly as we can get. And then also brick on the outside. And that gives them a very good acoustic. They're very quiet. They're very good for fire as well, but also the thing you talked about is heating. So they're very efficient in heating. So there's no need for heat pumps. In fact, NZ Living's homes, which they built, which we are replicating, they were telling us the other day that they install a 2 kilowatt wall-mounted heater into every apartment. Only half of them have ever been turned on, because the concrete and the brick absorbs the heat, and it also, they've got lots of windows and so on, so there's natural ventilation there as well. The best idea is to not need heating, because the house passively warms and cools itself. And obviously, that's already the case with these homes, and we aim to carry that on.
Great. Keep rattling through these. Question from Tony, do Simplicity Living developments assets get revalued to market over time, and what that value reflected in the investment funds? You can.
Yeah, so do you want to talk about the revaluation windows, Andrew? Or
yeah, so Tony, we've been working hard on making sure that this is, if you like, equitable to all investors, so that there's not big jumps in the value of the fund. And so yes, when a development is completed, it's revalued, and that's reflected in the market value at the time. And as I say, we're just trying to find some ways to smooth out that, so that there's not the sort of big jumps that hit in one way or another, but that will be fully valued regularly.
Yeah, so what we do is when we fund Simplicity Living, we have a 10% return, which is built into the cost of that funding. So members will get the equivalent of a 10% return while the project is being developed, and then it gets revalued when it's finished. And we expect in most instances that there'll be a revaluation uplift. There may not be always. It depends on the state of the market, but as a general rule, there'd be a little bit more when that gets revalued. And of course, the more and more homes that we build and rent, the less and less any one development will impact that. And then over time, of course, they just keep on renting and the money comes in and we just keep on getting that return. So the whole idea is to try and make it fair and equitable for all investors, no matter how early or late, or as long as they're in there, they're exposed to that, because it's their money, which is, you know, building, owning and operating these homes, that they get a fair return. We spend a lot of time talking with our supervisors and regulators about that. We've got a pretty good system I know, I think, which is sort of fair and equitable for everybody.
Yep, great. Question from June, which goes back to the question about bonds, really. She wants to know how the bond fund could have performed so badly. It's about as bad as the conservative fund. And the reason for that, June, is fundamentally, obviously, it only invests in bonds. And even though it's extremely safe in terms of the valuation of the value of your investment, because interest rates have gone up, so the value of the bonds that it invests in have gone down. There's no question of any defaults or so as such. It's simply a revaluation. But what is important to note about that is that as the bond yields rise, as they have, which is bad for values in the short term, the interest rate we're receiving on the bonds within the fund is going up. So now it's gone up from less than 1% to nearly 3.5% on average. And so gradually that bond fund will begin accruing that interest. And so if interest rates don't go up anymore, it'll gradually the returns will recover. But yeah, it's been very painful in the short term. We appreciate that.
Yeah, I think. Yeah. I think the other thing that you need to appreciate there is that that's a paper loss, right? So that, as Andrew said, those bonds are investment grade. They'll get repaid. The principal will get repaid at the end. And you know, so if we bought it for $1, it'll get repaid at $1, and then the interest will accrue on it. Bonds will go up again as well. So this is a patience game. If you've invested in the bond fund for a long term, the fact that it has gone down does not mean that those losses have been crystallized. They're just theoretical losses if you sold everything today. But if you hang in there, you'll get all of your principal back, and you'll get the interest that on those bonds as well. So which will be accrued in the value of the fund. We can give us a call if you'd like us to. Like us to talk you through it. One of the most difficult things to explain in investment markets is when interest rates go up, the value of bonds go down. It sounds good. It's very difficult to appreciate, but it's how it operates. But it is a theoretical loss only. In practice, you will get back the value of that bond plus the interest that accrues over time. So just be patient. Yeah.
An anonymous question. I don't see where your New Zealand housing is under your New Zealand holdings. It's such a tiny investment at this stage that it won't show. But once we've got there's enough for it to actually register, it will probably be listed as New Zealand direct property rather than under the New Zealand holdings. But we're just working on that now. Question from Colin, do you use any of the BlackRock funds like other KiwiSaver providers do? Shall I keep going, Sam?
Yeah, go for it.
The answer to that, Colin, is no. We use Vanguard for our overseas investments. We don't have any BlackRock funds at this stage, but who knows in time. And so another good question from somebody anonymous: any plans for a lifetime retirement type of fund?
Already tried that and shut it down. So we had a guaranteed income fund there for a while, which didn't have very much demand and suffered as interest rates went up. Very hard to guarantee an income when interest rates go up. So no, but I would say this: Simplicity is very, very keen on making sure that retirees get a better return on their money than they can currently get in the fixed interest markets, and that they get a very secure form of income. That doesn't necessarily mean guaranteed like a term deposit, because you have to be a bank to offer term deposits, or you have to put a huge amount of capital aside to guarantee that deposit. But we think that things like rental income, mortgages, the sort of investments that could provide a return which would be better than retirees would otherwise get, and it'll be a better risk-adjusted return. So very low risk, but a higher return. And so as we build up those businesses, I think we'll be in a position to offer something like a retirement fund or an income fund or something like that, which is really, really designed to protect capital and give a better return. Now, look, it's not going to be anything like any of the crazy claims we're seeing being advertised in terms of returns, because we believe there's inherently, fundamentally, a lot of risk involved in those returns. We're not interested in that. But if we can give retirees a little bit more for no extra or maybe even less risk, that would be fantastic. So we're moving towards that as we get more scale in our rental housing, as we get more scale in our mortgages and so on. We'll be in a position to do that now, but it's certainly on the radar.
Great, thank you. Question from Sue: will we still have to pay tax on assumed growth of 5% even if our funds have dropped this year? And so, Sue, the answer to that is that yes, for your overseas investments, which are taxed under what's called the fair dividend regime, that will mean that yes, you do pay tax on those. But where interest rates have risen and caused losses in bonds, those are allowable losses, so that will reduce the tax. And similarly, in New Zealand, if it's not taxed under FDR, so where there have been losses on New Zealand shares, those will be allowable too. Is there anything you want to add to that, Sam?
You're the expert there, my friend.
Question from Rob: given the Russian-Ukraine situation, what exposure do we have in China, especially as regards to Taiwan? Trying to remember if Taiwan counts as a developed market or not, but the short answer, Rob, is that our international investments are only in what are called developed markets, not emerging markets. And so we don't have anything directly in China. I'm not certain about Taiwan. I'd have to look on the list. But
yeah, we would have maybe some exposure via the New York Stock Exchange of Taiwan listed companies. I'm thinking particularly of TSMC, which is the biggest semiconductor manufacturer in the world. So there may well be some exposure there. It will still be, one of 3,000 investments though. So it is likely overall to be very small.
And the point of that being, from our point of view, the reason we excluded emerging markets was that you get such an exposure to emerging markets through the companies that are doing business in those areas. We felt that was a better way to address it, rather than going into jurisdictions that are not as well regulated as the main markets. And that is basically the end of questions that I've got, other than a note from John commending us on our choice of shirts. Sam, you apparently are representing the investment funds, and I'm representing KiwiSaver.
There you go, simplicity. Actually, that's a great observation. Thank you. It was unintentional, but you're right. That's what
exactly.
All right.
So I think that's everything.
Okay, fantastic. Well, listen, folks, if you'd like any more, have discussion about anything else, please feel free to get in touch with our team at info@simplicity.kiwi. Thanks very much.
Great. Thank you.
Thanks, Andrew.
Cheers all.
See you.